Hey everyone, this is Jeevakan. This week is going to be an important make or break week for the markets because the markets are at an important resistance and the FIAs have turned net buyers. And with the FOMC meeting ahead, so the market is going to have a huge move on the upside or on the downside. So it's better to play safe this week, and I hedge my portfolio as well. So we'll get right into the video and discuss these things in detail. The hiring freeze is on the rise and the inflation data has peaked from 8.6 to 9.1 in the month of July, which we have never seen before in the last 4 decades. And the important point is that the market is not reacting to this bad news. The FOMC meeting is about to be held on July 27th, and the expectancy is that there will be an aggressive rate hike this time as well, which is somewhere around 100 basis points. So before getting into basis points, we'll understand what is basis points. Basis points is nothing but 1/100th of 1%, which is if the Fed increases 50 or 75 basis points, then there will be 0.5 or 0.75% hike. So that's what we call as basis points. So last month the expectancy was 50 basis points hike, but they increased 75 basis points. This time the expectancy is that there will be 75 basis points hike, but if there is a 100 basis point hike, it will be bad for the market. And the $1,000,000 question is that how the market is going to react. Because previously for the 9.1 inflation data, the markets didn't react. In fact, the market went down. So we never know how the markets are going to react. So the markets are at an important resistance and the FIAs have turned net buyers. And I don't even remember the last time FIAs were net buyers for 3 consecutive trading sessions. So this is a good news for the markets. In the same way, I will hedge my portfolio as well. Just in case if there is a huge crash, my option positions will be profitable and my cash market positions will be in a slight loss. So that's how you manage your portfolio. So we'll look into the charts for further analysis and I'll tell you how I hedge my portfolio.
So I have opened Nifty charts over here. So let's analyze Nifty to understand the possible scenarios that might happen in the upcoming week. So as discussed before, as soon as Nifty closed above 16,200 to 300, we saw a 500 to 600 point rally the following week. So now the $1,000,000 question is what will happen the following week. So let's analyze by drawing some trend lines. So this is the trend line where Nifty has been trading for the last 7 or 8 months. So let's shift to weekly time frame so that we'll have a better understanding of this scenario. As you can see here, this is the trend line. So the next important resistance is 16,800 levels. So let's draw a resistance zone here. So the thing which we need to consider here is that whenever Nifty was able to close above this resistance zone, we had a huge rally of at least 5 to 10%. See here, Nifty broke out and closed above this resistance zone. Then Nifty had a rally of 10%. And here also the same thing happened. We had a rally of 8%. And here as well, it broke down and it closed above 16,800 where we went up to 18,000 the previous time. So 16,800 levels has been acting as an important resistance and support zones whenever the support or resistance is broken. In this scenario, when the market is going on the uptrend, this 16,800 levels will act as a huge resistance. So if we are facing a green candle like this the following week, then the probability of the market touching this upper trend line on 70,600 levels is really high. Only if there is a green candle next week and if the market closes above this 16,800 levels. If the market closes above 16,800 levels next week, there is a high possibility that the market might go to 17,500 to 600 levels to this upper trend line. But in the worst case scenario, if we have a red candle like this, the probability of the market going again to this lower trend line, or consolidating in this level is really high. So now coming to the important part, which is how I hedge my portfolio, considering that if there is a crash next week. So I have a portfolio worth 30 to 35 lakhs, and if the market crashes down, I might be losing some amount, like based on the fall we are having. So in order to protect that, what I did was, when the market was trading above 16,500 to 600 levels, I bought 15,500 and 15,000 put option. So if we buy put option, we'll be profitable when the market falls down. So the scenario is that if the market faces resistance here and if the market crashes down, my 15,500 put option and 15,000 put option will be in good profits, whereas my portfolio will be in losses. So the losses I'll be having in my portfolio if the market crashes will be hedged by the put options I bought, 15,500 and 15,000 put option. So both I bought 100 quantities, which means 15,500 quantities and 15,100 quantities. You can see in the screenshot over here. So why I bought 4 lots? So I bought 4 lots because the value of Nifty is somewhere around 8 lakhs, because the market lot of future market lot of Nifty is 50 rupees. So 50 into 16,200 is somewhere around 8.2 lakh. So if I have 4 lots, it is somewhere around 32 or 33 lakhs. So my overall portfolio is somewhere around 35 lakhs. So if the market falls down and crashes below 15,000, my losses will be nullified by the option bought position which I have. So below 15,000 I will not be having any losses, because if there is a high chance we might go into recession and go to 13,500 or 13,000 levels. If that happens, these 2 put options will be saving me from the losses which I have in my portfolio. So this is why I bought 15,500, 15,000 put option, and this is the right time to buy put options, because put options are cheaper right now since we had a huge up move. So it's better to buy put options when the market is at a swing high. So that's why I bought this put option. So if we have more positions, it's better to unwind your positions here, some of your riskier positions here. And it's better to book profits at these levels as well. So since the markets are not reacting for any negative news, we might be touching this resistance anytime soon. Since FII started buying, so we might reach this target within next 2 or 3 weeks if the Fed meeting turns out to be a non-event. So this is a huge event, so better to play safe. And what I'll be doing with my put options if the Fed event turns out to be a non-event. So if the Fed event on July 27 turns out to be a non-event, I'll be closing these 15,500 and 15,000 put option with meager losses of somewhere around 5,000 to 7,000 rupees. But that is not a big amount considering the portfolio size I have. Because if the market falls down, my portfolio will be in somewhere around 2 or 3% loss, which is close to 1 lakh. So it's better to book losses of somewhere around 5,000 to 6,000 rupees rather than facing a huge loss if I don't have that put option. So based on your portfolio size, if your portfolio is 10 lakh or 20 lakh, based on that value, you can buy the number of lots you want and you can hedge your portfolio. And this is the right time because the put options are cheaper right now.
So this is how I hedge my portfolio. Even if there is a big crash after the Fed meeting, the option positions will be in profits and my cash market positions will be in loss, which will nullify the effect of the crash. So that's how it is important to hedge our portfolio if the portfolio size is more than 10 or 20 or even 30 lakhs. And if the Fed meeting turns out to be a non-event, I'll close my hedge positions with minimal losses. So it's not going to be a big loss. It's going to be just 2,000 or 5,000 rupees loss, which is pretty normal. And my cash market positions will be in a safe position. So it's better to hedge your portfolio on a big event like this. So that's it. Thank you so much for watching the video. Signing off until next time. Cheers.